Hey Deep Valley community, welcome back. You guys are like family to me now. So I've designed these videos with an idea of what I wanted to know about when I was starting out, but if there's something that interests you, then please let me know. So the topic of today is whether to be invested in small caps or large caps, and what makes a better return. So as always, if you're new to the channel, please subscribe so we can go on our journey together. So the first thing to say is depends on the definition of what is better. It's kind of like depends on the definition of what is, right? So a better return doesn't always mean the strongest return. It could be down to your risk tolerance. It could be that if you're really truthful with yourself, you don't actually want the volatility that comes associated with a better return. You can just be quite, if you're honest with yourself, you can be quite happy with a, let's say, a 7% return annualized, and that's going to have less volatility, but you're going to be able to draw on that capital if you need it, let's say, over the next 2 years, versus if you invest in a smaller cap, you might be locked in for slightly longer. So that is the first question. You got to be honest with yourself and say, actually, what do I really want? So the next question is, what are large caps aside from the obvious, a large market cap? So a large cap typically is quite well entrenched in our fabric of the way we do business. Now it doesn't always have to be a global business, like Comcast is quite a large company, telecom company, and it's predominantly in the US. So it doesn't, and it has the same market cap incidentally as Netflix, which is much more of a global business. So this is something to think about, that the large caps are more stable. Large caps have been through more cycles typically of business contractions and business expansions. So it's not always that the large caps are kind of static. You look at Amazon is like constantly innovating, constantly just a huge disruptor. It just kills off retail. So a large cap, even in the example of Amazon, doesn't necessarily really ooze free cash flow. If you look at how much free cash flow something smaller like Facebook does, Facebook is just pounds on the free cash flow machine. So these are different kind of pushes and pulls. So to think about in the case of large cap investing. On the reverse, you can also think about large caps, the fact that it's more difficult for them to keep growing that return. If you look at a business like Apple, for them to keep compounding that return forward, it's really difficult, especially when a large portion of their revenue is down to iPhone sales. So I don't have a position in Apple, but I'm quite bullish Apple as a company. But that is certainly a risk. Their ability to funnel people into their ecosystem really comes down to their ability to have strong iPhone sales. So moving on, small caps often are small for a reason. So they might just serve a very particular niche. So they often, not always, but often have large customer concentration. So this is a risk, right? And they're often vulnerable. They may not be for as many business cycles. So there's a lot of risks in small caps. Also, small caps are perceived to be more risky, so they attract a certain type of investor that is more of a retail mindset, and they get excited when the share price is rallying up, and they get despondent when the share price is falling. So there's more vicissitudes in small caps. Now, this could be of added benefit for the right type of investor, because as there's a larger discrepancy between the market cap of a small cap and its intrinsic value, then you could take advantage of that. You could really buy when things are just doom and dire, and you could exit that investment fairly quickly over the next 2 or 3 years as it approximates fair value. This is an approach that I use. It doesn't necessarily mean it's the right approach for everybody, but I prefer small cap investing. And moving on, so this is a graph that I've used from Deep Value, the book by Tobias Carlyle. Was a book that really influenced me as an investor. I cannot recommend this book enough. So this is a book this is a graph that I took from his book, and you can see, so I've seen zillions of these types of graphs, so they always vary slightly on the actual returns, but the trend is there. So glamour, or what I refer to as sexy stocks, typically over the next 5 years do quite poorly from where they are today. So looking from today going forward over the next 5 years, you can see that small caps typically are a price beyond perfection, and they actually, the ones that really have high multiples today, typically do quite poorly over the next 5 years. And when it comes to the larger cap companies, they do slightly better. So you could make a very strong argument that during the bull period of, let's say, 2017 to 2019, large caps, we saw this is what we saw. We saw that large caps were basically just taken off into the stratosphere. And conversely, you could make the argument that if you're buying today small caps, you're buying today companies at low multiples, over the next 5 years, smaller caps will do slightly better than larger caps. Now, this is important right now. The difference between the smaller caps and larger caps doesn't look significant. However, there is the key, as I'm talking about in a post that I wrote about recently, is to be selective. The point is to understand that you're not just buying an index necessarily. That could be something, but not necessarily of, let's say, the Russell 2000. A slightly better idea would be to understand that is a really competitive playing field, just buying an index, and that there's a lot of investors all around the world doing that same strategy. A slightly better opportunity would be for you to say no to many businesses that come your way. Try to reach a reason not to invest as quickly as possible. So, for example, look for businesses that have a very strong balance sheet. Look for businesses that actually have a history of generating strong free cash flow, and look for businesses that are stable. So not necessarily like 2 years of strong free cash flow and then the next year just nothing to show for it because they are quote unquote investing for growth. So look for businesses that have a strong track record of generating strong free cash flow. So in summary, I believe that investing in small caps is more rewarding, but that's because I can withstand the volatility associated with my portfolio. But the irony actually transpires to be that actually even large caps are fairly volatile. We saw just now in March of 2020 how large caps also sold off. Small caps sold off, large caps sold off. The market, when it comes to fear, the market doesn't care about anything. When there's fear involved, it's a sell at any cost. So I believe that small caps are better than large caps because you can get into a business that is less followed by analysts, that is less followed by investors, is less of a cult status. So you can get a business that generates strong free cash flow and you're not paying a large multiple for it. And some of these businesses, they just tick along over time. And once the narrative changes around that business over time and the business pays down debt and the business starts to have some growth, because it's easy for them to grow orders from a small base. So something positive can happen, and this leads to substantial repricing at a fairly rapid clip. So in summary, please subscribe so you can follow me on my next value investing journey. Many thanks. Bye-bye.